Hey everybody, Preston Brent here with our Trader User Group Weekly Roundup. This is for the trading week ending March 29, 2019. We rounded out and finally put in the books Q1. What a Q1 it was, I guess. We saw, but first, this past week, the Dow, S&P, NASDAQ, Russell, they're all finished in the green. The Russell leading the way at 2.2%. Followed by the Dow with a very healthy 1.67%. Then the S&P was at 1.2% for the week, and then NASDAQ was the trailing winner for the week, which is unusual for NASDAQ, coming in plus 1.13%. We also saw most of the indexes globally finish up for the week on trade optimism talks, primarily China, and the markets here rose up really nice. We've also seen volatility. It came in for the week 16.8%, so it fell down to close out the week at 13.71. But as I said, and oh, by the way, the current PE ratio, the forward guidance, the forward 12-month PE ratio is still around 16, slightly a little bit more. So the PE ratio is looking good as well, and a reasonable number. It's down. Excuse me, I still got this cough. It's still down from last year, March of this time last year, by about 10% or so. Now, also, Q1 is in the books, as I said. What a Q1 we had. I mean, the S&P ending its best quarter since 2009. It gained over 13%. Of course, it did follow, I'll remind you guys, the worst quarter drop that we had in quite some time. Q4 came in down almost 20%, with December being the worst performance since 1931. You know, we saw some of the big gains in the stocks were stocks acting like bonds. NASDAQ also finished up Q1 16.49%. Of course, that was followed by one of the worst performances of NASDAQ in Q4 of last year. And the Dow rose 11.2% for the quarter. I'm sorry, guys. We'll keep pressing on here, which is the best gain in the Dow for the first quarter since 2013. So it's kind of a strange time for stocks. We're seeing defensive sectors like real estate funds, REITs, which pay good dividends, doing really well. But we're also seeing growth in technology. The best performer this week, sector-wise, was industrials, up about 2.8. The worst performer was utilities, down slightly, 0.44%. But as all of our members know, utilities has been one of the best performers year over year, which is why I'm saying that, you know, sometimes it's a bonds versus equities, but it's kind of a strange year where we have defensive as well as offensive stocks all doing well. We've also seen this past week an inversion in the yield curve. That would be 3s over 10s. That would be the 90-day T-bill over the 10-year. Although on Friday it moved back into the green again with the Treasury just by 1 basis point. The 10-year is over the 90-day T-bill by just 1 basis point. So for all practical purposes, though, at least it moved flat. So we're seeing that. Inflation is kind of still in hibernation. It's still coming in around 1.8%, just south of the Fed's 2% target rate. But we're still seeing, and there's been a lot of talk recently, you've probably seen it on the business channels, where everybody's trying to get the Feds to cut rates a little bit more. I'm not really in that camp, although I think right now they consider their current rate at 2.25% a neutral rate. We did see also this past week Q4 growth reduced just slightly to 2.2%, giving full year GDP numbers at 2.9%. Although we also saw this week consumer spending, which represents, I'll remind you guys, about 70% of GDP. It came in at an anemic 10 basis points growth in January. And that's after falling 0.6% in December, which was really a bad month all around. We're also seeing growth having issues in Europe. In both inflation and growth, they're both lower than what Super Mario Draghi really wants. Eurozone they'll be lucky if they come in this year at 1% GDP. And it's really ironic. You know, you ever heard the saying, when you go to the bank and you'd like to borrow money, you really would like to, That means you need it and the banks don't want to give it to you. But when you don't need the money, the banks are willing to give it to you. It's kind of working the same way with fiscal policy across a lot of countries that make up the Eurozone. Italy, which is in an official recession, Spain, Portugal, France, they all would like to spend more and do more stimulus, but they can't. And yet countries that can afford to spend more, like Germany, Austria, and Finland, maybe the Netherlands, they don't want to spend more. So it's one of those kind of situations where those that need fiscal stimulus can't, and those that don't want fiscal stimulus can. That's the problem with the euro in a nutshell. All on a common currency. When everybody had their own currency, they could devalue the currency, increase their exports, and kind of work their way out of the debacle. But when everybody's on the same currency, and most of it's controlled out of the ECB in Germany, then you're pitting the Northern Europe, which tends to be more better well run fiscally than Southern Europe, which tends to be more socialistic. And you got those countries willing to spend a lot more than they have and give free money to everybody. So it's going to be an issue with the euro longer term. I think near term it can go anywhere, but longer term it's going to have some big issues. What I've got on the screen right now is the S&P 500 E-mini futures. You can see we've just been in a steady move up pretty much all quarter, okay? And you can see the steady move down that we kind of initiated back here in September. I mean, sir, we made all-time highs back on September 20th, and then we've just been in a steady decline since. And we've had this V bottom, as I've talked to our members about, till I'm blue in the face. And this V bottom was caused more by what our Fed central bank chair, Powell, as we like to affectionately call him, Power Ranger Boom Boom Powell. He came out on December the 4th, of course, and came out and said quantitative tightening is on autopilot, and he made use of the words quantitative models and economic models, which is not what the markets wanted to hear. And it gave us, one of the worst quarters we've had in quite some time. In December, it was one of the worst Decembers that we had since 1931. And then boom, away we went. Then he kind of came out on January the 3rd and the 4th, I think the 4th. And he said, oops, my bad. I didn't mean what you thought you heard come out of my lips. So let me change that. So he just changed all of this by, reversing almost 180 degrees Fed policy here in the US. And you can see where we are right now. We're kind of right back where we started. You can see this shaded zone here, slightly above the pivot highs back made in October, November, and then December the 3rd, right the day before Boom Boom Powell came out and just set the markets aflutter. So for all practical purposes, the markets were sitting at 28.14. And then Boom Boom Powell on the 4th came out on December the 4th. And when the markets were sitting right around 2,800 and made his comments, and then poof, off we went. January 3rd, here we are sitting right here, and he said, my bad, my mistake. And then all it's really done is move us right back up into the range of where we were before. So now where do we go from here? Well, if you look, these are EMAs, the 50 and the 200 EMAs. They're a little bit more sensitive than using SMAs. You can see the 50 has crossed well back above the 200 again. We're coming up to our 2019 highs. We're moving into earnings season coming up, and earnings growth is expected to be reduced in Q1, is expected to come in a little bit less, about 3.8%, which is the worst growth that we've had. And I think it's going to be down year over year. It's going to be down 3.8%. So that's not good, right? I mean, that just shows that it'll be the first time in quite some time that we've had a year over year corporate earnings growth since the summer of 2016, right? So that's a little bit about where we're sitting here. And also, I will remind you that as we kick off April the 1st, it's also April Fool's Day. So I guess it's appropriate for the markets, right? As we kick off going into earnings, April Fool's, great way to kick things off. So this is where we're sitting right now. We did finish Friday on a positive note where the inverted yield curve moved back, as I said, 1 basis point up. If we look at the Dow, so you can see here, we're just slightly below the 2019 high. If we look at the Dow, you're going to see the same thing. You're going to see the, as we move it over, you're going to see the 50 over the 200. You can see we're just slightly below the 2019 high. I'm projecting the Dow to move up over and make new highs here over the course of the next week or so. Same thing with the E-minis, by the way. And then, of course, if we look at NASDAQ, same thing. You can see the NASDAQ 50 over 200, just slightly below the 2019 all-time 2019 highs, and just slightly below the all-time highs on NASDAQ right here, 50 over the 200. Okay. And then, of course, if we look at the Russell, which is not as strong as the others, remember the Russell leads the way both up and down. You can see clearly here, the Russell made 2019 highs in February. And on the E-mini S&Ps and the E-mini Dow futures, and on NASDAQ, we made highs in March, actually. So the Russell seems to be leading the way back down. You can see this regression channel here. It's very wide. You can see the little number there. If you can, it says 0.519, so it measures the width of the regression channel. So it just says it's been very choppy. Also notice the 50 is still below the 200 in the Russell. So, and if you guys will recall, we're slightly above the 50 EMA price-wise, sitting almost on the 200 EMA. For me to kind of get an all clear, I want to see the Russell get above this blue regression channel and start moving back up again. Take out this prior pivot high here, sitting at 1576.19. You can see the upward momentum in the MACD here is the same with all the others. So perhaps we'll get that going into earnings. Now, earnings have already, as I said, they've been reduced. Okay, we've got earnings coming up. They have been reduced. It's looking like a year-over-year fall in earnings is what I'm looking at. Right, be the first time since summer of 2016. But this is already priced into the market. So I think everybody, now that we priced in really a low bar for earnings, what everybody wants to see is where's the forward projections, where's the forward guidance, and that's what's going to get us up. Now, I don't think the markets are too far or will fall too far, only because everybody seems to be waiting for the Trump trade deal, you know, China and Trump. And we'll see how that works out. I think about 70–80% of a successful trade deal is already priced in, but it does tend to make it choppy. But I think that's kind of it's put an artificial put in the market until that deal gets done. So it could be a pop and drop where it pops up, makes new 2019 highs, begins to approach all-time highs, and then we sell off again. So that's kind of where I'm sitting. And if we look at volatility, you can see the vol index is in the green. So that means we're back down relatively low. I mean, we're still elevated. I mean, it finished the week at 13.71, but you know, you can see the high for the week well over 17.8 almost. In fact, we had 17.85, the highs for the VIX for the week. And then we've just spent the most of the week selling back off again. Okay. And if we look at China, of course, China is doing good, or the tracking stock for China is one of the ones I use is ASHR. And you can see here, we actually made new 2019 highs on Friday, just because China is betting that, you know, good news came out this past week from U.S. Trade Representative that said that things are working fairly well. They had productive discussions. Now they're going to start discussions next week here, or this coming week here in the U.S. So that's why it's also adding a little bit to the markets, especially China. And generally, where China goes, so does emerging markets. So here's the emerging market ETF. You can see here, although it has been pulling back just a little bit, it's sitting right on the 200 EMA. So there's still risk in this, but we're also getting an upturn in the MACD. So it just looks like the markets want to go on a kind of a grind higher mode, at least near term. Okay. If we look at the skew, let's look at the front month term structure. You can see here the front month term structure in volatility is in the green. So that would also imply that we're in contango. And we only moved out just briefly on the 25th of March. But most of this week, we've been in a contango environment, which basically means the front month vol futures is higher than the VIX. All right, so that's a good sign. And if we look at the back month Well, let me get the back month on here. You can see here we're even more in contango, right? We're deeper in the green. So again, the markets are not pricing in fear going through Q1 earnings. I think what the markets are anticipating is a China trade deal. So we're not seeing volatility bid up, not only in the front month, but the back month term structures. Okay. So that's a good thing for the grind higher bulls. I mean, that's kind of what the bulls want to see. Now, what caused all the excitement this week was the 10 over, the threes over 10s, the yield curve. And if we look at the treasuries, if we look at the 10-year interest rates, you can see we blew. Now remember, my forecast for the 10-year was 2.5. We blew right through it. And you can see over the past 3 days, from Wednesday, Thursday, Friday, the 10-year has been moving up a little bit, which is a good sign. That has helped take the inversion out of the yield curve, which is the 90-day T-bill. And you can see where we're sitting right now. I think it's going to work its way back up to 250 if things start to settle in. But that is my target area. That was my target area when the 10-year was at 275. All right, bringing it back. This is just 25 basis point move. That's a pretty good move in interest rates for a 10-year. But this is what's got the markets at Twitter, I guess. Okay. And if we look at the bond market, remember bonds move in the opposite direction of interest rates. You can see this huge move off the lows here on the beginning of March. We have spent all of March with bonds moving higher. Okay. Almost every day. Bonds were off the 143 at 19 ticks, and now they're finished at 149. That's a big move for a month, guys. A really big move. Like I said, the big move in the 10-year interest rates, 25 basis points. So this is a big move in bonds. I would probably be more inclined to play a little bit of a pullback in the bond market. The value area for bonds is sitting at 145 and 27 ticks, which to me, I would not want to be long up here. I would be more interested in taking some short positions in the bond market. Okay. That would mean you would be taking a long position in interest rates, or if you wanted to play it that way, you could play TBT to the upside. You can see TBT follows the interest rates, and you can see where it's starting to bottom out here. Or another way to play that is TLT, but you would be trading TLT to the downside because it follows the bond market. And the value area in TLT is around 120. It's at 126 now, so we could perhaps close this gap right down here, but I would say picking up a put or two in TLT makes more sense than picking up calls over the near term. Okay, so that would be treasuries. Currencies, same thing. If we look at the dollar's been trading in a wider range for quite some time. You can see the value area going back 1 quarter for the dollar is about 95.93. It's at 96.84 right now. So we're in this wide range, kind of going all the way up to 97.5, down here to 95.5, roughly. So this is just kind of where I'm seeing here. We're going to have some overhead resistance here in the dollar. Remember, when the dollar gets stronger, commodities tend to get a little bit weaker, okay, especially gold. And you're seeing just, where we're sitting right now. And if I look at the euro, I've never been a big believer in the euro. You guys that follow me understand that. And you can see the euro has been moving down as the dollar's been moving up, right? And the euro, I think, has got better or worse growth prospects than the U.S. And a lot of money from Europe and Japan is flowing over here. So you can see this. And if we look at the yen, which tends to be a flight to safety kind of thing, you can see the yen has also spent the month of March moving up, and now it's moving back. Typically, the yen moves like our bond market. Okay, they're more correlated, clearly, and you can see the yen is sitting right on its 200 EMA. So this tends to show that there is still a global growth scare out there, and we got to see if there's going to be a contagion effect across Europe. And if it is, then we're going to see the markets pull back a little bit more, I believe. Okay. Energy, we'll go to my baby oil. You can see here oil is hitting that low 60 area. Now, I am on record as saying down here I wanted to go long oil. When it was at 75, I said go short oil. We got a good trigger to go long oil down here around the 42, 43 area. I said it would go up to the mid 50s. Now we're sitting at the low 60s, 60.14, and I'm on record as saying, you know, in the low 60s, I'd be more willing to look at a potential short than a potential long. Oil right now is governed basically by just a few factors, most of them not supply and demand, but geopolitical, with OPEC cutting production like they are. A lot of Trump getting more tough with Venezuela. They pretty much effectively sidelined their oil exports. So that takes less oil, or that takes more oil out of the global markets, which tends to put upward pressure primarily on Brent versus WTI, which is the US based oil. But you can see here where we're sitting. We're right in the middle of this regression channel. And it's a fairly narrow regression channel, 0.93. So it's a tight range, but you know, we're in the middle here. So to me, there is not an overarching degree for me to want to short oil at this point. If we get up towards the blue, I would be more interested in taking a short. Look at the MACD. It's almost flat, okay? Almost no divergences at all, which indicate that oil is just going to be left to probably an upward bias near term. And oil, I've noticed on any kind of economic data that shows global demand, not for oil, but just global growth is slowing, oil is kind of following suit. I don't see it getting much higher than this, but let's watch it and see, because those geopolitical things can just rear its ugly head and overextend oil, because oil, like most other commodities, tends to overextend both to the upside and to the downside. Okay. Same thing with gasoline. If we look at gasoline, um, again, you can see here with gas, we're well north of where we should be. This little dip here, I'd like to see gasoline move up a little bit more, and then I'd be more than willing to sell this thing. If I put a regression channel on gas, and let's just start it from this move right here, right? That'll give us a tight regression channel. You can see that one right there. Now, if I were to do another regression channel, I'll just take this one off, and let's do it from the lows. It'll widen the regression channel just a little bit, right? Right in that area there. And that's probably a more accurate reflection of gas. It's typically more choppy anyway, but we're clearly on an upside bias here. If I step it out to a weekly chart, you'll see gas just fell off the table. Up in this area here, I was talking about shorting oil and gas. Gasoline futures, not nat gas. And you can see now we can run up to this value area here, sitting a little bit over $2 a gallon, 2.069. If we run up here, I'll be a more active looking at shorting this thing, but we're going to be running into some serious resistance here with gasoline. Okay, just serious resistance. The other one that we're looking at big time is, let's look at metals, but we're going to look at palladium. All right, I'm going to give you a view here of palladium. This was the trade here, and I've talked about palladium. You can see this regression channel. It's been very tight. All right, I mean, just a very tight rundown. Let me just redraw this regression channel. I'll refresh it just a little bit. This is a daily chart, folks. It is not a weekly, it's a daily. And if I draw this here, you can see just how fast palladium fell. We had a bearish divergence trigger right here. And for those members and those that had more than $250,000 in your account, net lick, I had recommended, you know, you can go short on this daily chart. Now you've got to set a $5,000 to $8,000 stop loss, but it was a high probability trade. All right. And we moved on that trigger. We moved down from 1542 down to 1342. That is 200 points. That's $20,000 per contract on the trade, guys. So a really good move. Now, I do believe this thing is going to attempt to make a move back higher, probably up into the 1400 range, and then it's going to roll back over again. And that would be the trade. Okay, I mean, that would be the trade that I would like to do. Now, in our membership group, we've looked at this 3 ways from Sunday, trying to work ways for smaller accounts to trade this. And the reason why it's difficult is palladium does not have options. So you can't hedge your short bet with long out of the money calls. Okay, and nor can you hedge your short There's no other way to do it. But that also means by the same token, longs that have been in palladium for quite some time can hedge their bets with puts. You can see if I move this out like this, right? You can see this huge. Let me just take this off the screen here, just kind of clear it up for you guys a little bit. You can see that downwards move came almost right down to our 38 fib node, right? 1287. And it's going to eventually come down here to this value area of 1177. And you can see that divergence here. There was no divergence from this pivot high here to that pivot high here. So that meant any down move is going to be bought, and it was bought on that cross up here. But then when we got that pivot right there, for those larger accounts, that was the trade, folks, 20,000 a contract. That was the trade to take. You can see we're almost right at a value area here, sitting at 1309. So I want this thing to climb up a bit, and then we would look for another short entry on palladium. If we look at gold, gold is another one that is trying to form this cup and handle, and this handle broke down the other day, right? And you can just see here this steadily drumbeat lower over 1, 2, 3, 4, 5 days. Gold has moved a little bit lower. It's below the 50, above the 200. So we'll watch it really closely. Our trades here in this trade, you can see this cup and handle pattern here. Down in this area here, I was recommending bull put spreads. Okay, it was a low-hanging fruit kind of trade in the options market on gold futures or in GLD. It was very choppy, but especially in gold futures, you could get south of the market down around 11 and a quarter, 1100 down in this area here. It was a really good high prob trade. But now up in this area here, it's almost at a value area going back 90 bars. So there's no trade right now in gold. There's just none at all. So that's gold and palladium. And I showed this last week, so I'll bring it up again. If we come over here and we look at lean hogs, you can see here in lean hogs with the swine flu, we're getting on this daily chart up in this area here. Remember what I said, guys. This is another potential bear market or a pullback here, and we've come all the way down. We may come down a little bit more, but we've got a nice bearish divergence fire off on this one as well, from this peak to this peak here. So that would suggest that it was a good short. The value area in lean hogs is 124.77. They've got the swine flu over in China. So this means that shorts were worth the taking here. Okay, so I just put that out as an extra for those of you that are on this free webinar this weekend. But commodities can be very, very fruitful and very lucrative if you understand how to play them. Because more so than equities, commodities have the supply and demand, the elasticity and demand coming into play here. And if you understand it and you understand how to read the longer term play of the commodities, like in the meats market or in the ag, there's going to be some things setting up in ag as well. And I'll be talking about that for our members at this weekend's weekly Market Watch coming up on Sunday evening. All right, everybody, that's kind of where we're sitting right now. Members, I will see you this Sunday evening. If you're a non-member, I highly encourage you to come in. We've got some good trades here that we're playing for small accounts, Reg T accounts, as well as some portfolio margin accounts. We put on trades in our secret trader for both. So it should be pretty good for everybody. Have a great weekend, everybody. And this Monday is April Fool's, so let's enjoy it. Take care, folks. Ciao.